What if you could peek over the shoulder of a billion-dollar investor right as they're making a huge move? Well, today, that's exactly what we're doing. We're tracking a market whale and their massive, incredibly calculated bet on PayPal. We're going to break down exactly how they're doing it, why they're doing it, and what it tells us about this company.
So this is the big question, right? What's their secret? Because this wasn't just a simple case of buying a bunch of stock. Oh no, the clues we're seeing in the options market point to a much, much smarter strategy. One that's actually designed to win even if the stock doesn't move an inch.
All right, so here's the scene. It's late December 2025, and someone with some seriously deep pockets starts making waves. They place this enormous bet on PayPal. But get this, it's not a bet that the stock is going to rocket to the moon. It's something way more sophisticated. It's a bet that gets them paid right now for something that might never even happen.
Okay, so to crack this case, we have to look under the hood of the trade itself. The financial tool they're using here is something called a cash-secured put. And honestly, the easiest way to think about it is that they're basically selling insurance on the stock.
Just imagine this whale's acting like a tiny insurance company. You've got other investors out there who are worried PayPal might drop, so they buy what are basically insurance policies. These are called put options. Our whale sells them these policies, collects a bunch of cash up front, and in return, all they have to do is promise to buy PayPal shares if, and only if, the price drops below a specific level, in this case, $50. So this sets up what looks like a win-win scenario for the whale. I mean, look at the two possible outcomes. First, if PayPal's stock just stays above $50 until February 2026, the options simply expire. Poof! The whale just keeps all that cash they were paid free and clear. On the other hand, if the stock does fall below 50, well then they're forced to buy a company they already seem to like, but they get to buy it on sale.
And here is where that built-in safety net really becomes clear. Because they collected all that cash up front, their actual break-even price isn't even $50. It's $49.30. Now, with the stock trading around $60 today, that means PayPal would have to absolutely crater. We're talking a drop of almost 18% in just a couple of months before this whale loses a single penny. Now that is quite a cushion.
But believe it or not, that premium they collected is only half the story. The real genius here, the part that makes this so attractive, is how the whale is using today's high interest rates to create an income stream pretty much out of thin air.
So remember all that cash they had to set aside to secure the trade? That's called the collateral. And in this interest rate environment, that is not dead money. While this whole trade is playing out, that cash is sitting safely in U.S. Treasury bills, just earning a nice risk-free 4.24%. You add that to the income they got from selling the option in the first place, which works out to be over 9% on an annualized basis.
And here's the kicker. You put those two income streams together, and the whale has basically manufactured an investment that yields an incredible 13.36% a year. This is the double dip that the research highlights. I mean, think about it. In a world where it's tough to find safe yield, that kind of return is absolutely fantastic.
Okay, the how of this trade is brilliant. We get it. But why PayPal? Why was this whale so confident that the stock wouldn't just collapse right through that $50 mark? Well, the research makes a powerful case that the $50 price level is like a fundamental fortress, a valuation floor that is just incredibly tough to break. And this $50 fortress is built on three main pillars. First, at that price, PayPal's valuation, its price-to-earnings ratio, would be just dirt cheap compared to its own history. Second, the company is an absolute cash-generating machine. And third, PayPal itself is out there in the market buying back its own stock, which creates a natural floor of demand.
Let's just focus on that cash flow for a second, because this is a huge deal. At a $50 share price, PayPal's free cash flow yield, basically the cash it spins off relative to its price, would be almost 12%. To give you some context, that's nearly 3 times the average for the entire S&P 500. A company generating that much cash is like a magnet for value investors, which helps create that strong support level.
And when you look at the competition, you really start to see why PayPal is the target here. It's not some high-risk speculative fintech that isn't even making money. But it's also way, way cheaper than a stable, defensive giant like Visa. PayPal is sitting in this unique sweet spot. It's a profitable, dominant company that's trading like a value stock. And for a big investor, that's a very compelling set.
So let's put it all together. What's the final verdict? We've seen the brilliant trade structure, we've seen the solid fundamental case for value. But now we have to be honest and weigh the potential rewards against the very real risks. No trade is a sure thing.
You always have to consider the other side of the coin, right? The biggest risk is what they call a value trap. What if PayPal looks cheap for a reason? What if its business is being seriously disrupted by competitors like Apple Pay? You also have to worry about a deep recession hitting consumer spending, and of course, there's always a question mark with a new CEO trying to steer the ship. But the original analysis argues that for a quick 56-day trade like this one, these longer-term worries are maybe less of an immediate threat.
And this all brings us back to the core idea of why this trade is just so powerful. The whale has found a situation with three huge advantages, or asymmetries, that are all stacked in their favor. On valuation, they get the chance to buy $1 for maybe 42 cents. On income, they're creating a 13% yield when that's almost impossible to find. And on probability, they win if the stock goes up, sideways, or even if it drifts down a bit. They just need it to not collapse.
And this quote from the research just sums it all up perfectly. The bet isn't that PayPal is about to have some massive rally. The bet is simply that, at a certain price, the business is just too strong and too profitable to completely fall apart. It's a bet on the floor, not the ceiling. And it really leaves us with a fascinating question. In a market this crazy, maybe the smartest move isn't trying to predict the future, but instead just getting paid to bet that things won't get dramatically worse.